Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your mortgage voice, and I'm here each and every week, and we bring to you information about mortgages, about what's happening in both the mortgage and the real estate industry, and how some of this information translates to you as the borrower in the rate you use, the product that's out there available for you to be able to get. Most of the time, we talk about difficulties with getting a mortgage for some borrowers. Why do we do that? Because 99% of the lenders out there, whether it's a mortgage broker, mortgage banker, or the big box bank down at the corner, they're going to have 30-year fixed rate loans all day long. And they're going to have it for W-2 employees who've been working at the same company for 10 years plus. And they're going to have it for Fico score people 700 and above. Now, you may think that that's a lot of borrowers, and it is. And most borrowers, and I would say that this is true across the board with not only my own company, Malibu Funding, who sponsors the show, thank you very much, but also most lenders who are out there. Your average FICO score is over 700 and has been really since the crash of 2008, which is a good thing. However, not all borrowers have a W-2 paycheck and are 750 FICO score borrowers. Many borrowers are self-employed. Many borrowers don't have great credit. And by the way, the not great credit lender or the program that you most commonly associate with bad credit are FHA loans. FHA loans have a great many positives about them. They have negatives too, right? You have to pay an insurance and you have to pay it for the life of the loan. There was a time where it was 5 years and it's over. There was a time, of course, when if you got to 80%, you got rid of it. But you have to refi this loan now to get rid of that mortgage insurance, which is fine. Refis are always there, but you're not quite sure what the rate's going to be if you get the loan now, and it takes you 3 to 5 years to be able to get to 80% LTV, loan to value, on the property in order to get rid of that. So what we do here with the show is try to focus on, yes, we'll focus on what everybody else focuses on, but we'll also focus a great deal of our attention on those neglected borrowers. Now, there are political ramifications for all this, right? In 2008, people were blamed for giving loans to people who couldn't repay them. The mortgage broker loan was accused, and probably had some truth to it, to giving loans to a lot of people who could not afford it, shouldn't have gotten the loans, and i.e. that's what caused the mortgage crash. I think there's a relative truth in some of that. However, in many of these concerns, there is a hidden agenda, i.e. stay away from low-income people. And who are the low-income people? Okay, so when you do that, you start to get political, and I don't ever want to get accused of being political, because what we're trying to do here is to supply some information and some answers to those people who are running into problems trying to get a loan because of situations either with their credit, or they're self-employed, or they're non-citizens, or they have a number of other challenges to their particular loan needs. For instance, let's say I worked for a company for 10 years and I was a W-2 employee and I made X amount of dollars and I want to buy this house. Okay, that's great, sir. Can we see your taxes? Well, last year I went from W-2 and I opened my own company. So now I have my business tax returns for my own company. Can I use W-2 from one year to business taxes the other year? These are some of the issues and problems we deal with. COVID is its own issue. And if you're out there and you're thinking, you know what, that is my problem. I had a great job, I was working, and I got laid off. And I went into forbearance, and now it's been 8 months later, and I'm still in forbearance, but the rates are so good I could lower my rate by 3 to 4%, or 2% or a 0.5%, save myself a ton of money, and I could, then be able to afford my loan because I've got not rehired, but I got a job, but it just pays a little bit less. If you're in that category, there are some solutions. So being out there and listening to what is happening in both not only Malibu Funding, but all lenders, we all deal with this because in the back of our minds, we do not want to lend to somebody who won't pay it back. We're on the hook for it. It's kind of the way it is right now. On the same hand, in the same vein, yeah, something like that. We want to be able to offer loans to people who can afford them, even if they're not necessarily your quote unquote A paper person. They used to call it subprime. They used to call it B and C paper. They used to call it, a million of other things. Today they call it non-QM, non-qualified mortgage. And as the language and the usage of different words gets changed from decade to decade, the main thing here is there are a lot of people at the low end of the economic scale who want to buy a house. Rates are so low now that they can afford to buy a house. And so how do we get these people into a loan? Still the same problem, right? Fico score and how much money do you make and the prospects of you keeping that job for how many years. That's the formula everybody works with. And if you are hit with a questionable job question, like, okay, I see you work overtime at your job, but how long have you worked overtime? And can you guarantee that that overtime is going to be available for the next 2 years? These are some of the questions that you get. I had a union employee who was changing addresses. They couldn't afford their property where they lived, so they were going to move to a different state. Now, being a union person, they were guaranteed a job when they moved to the different state. However, they couldn't get a letter from the union in the new state to signify that that's the way it was going to be. It's just not within the union purview or the regulations to be able to do that. So what happened? They couldn't get the loan until the person moved there. If the person had moved there, they could have gotten the letter saying, you're employed now here. But they didn't want to lose the overtime pay that they were going to get around the holidays right now, between now and the new year, in their current job. They're a line person, whatever that is, electrical union in New York City. So they didn't want to lose that particular overtime pay. They wanted to move after, and they wanted to have the house purchased now so that the person going to the new house could go there with their children. Now, oddly enough, it was also a VA loan, and the VA veteran was the person going to Texas. So there wasn't an occupancy issue. Now, you may hear a lot of things in what I'm describing to you as being somewhat or partially true to what you're experiencing. And I really understand that. So if you have these type of problems, you're not a bad person, a bad borrower. You're just somebody who's caught up in a mess. You need to look at companies that specialize in this particular situation. And how do you do that? You need to go online and start to make some calls. I know it's not easy, especially with COVID. You rarely are going to get somebody on the phone. Emails are really tough right now because they're so overwhelmed that any company sending an email is probably not going to get answered right away. I sent one, although to be honest, I sent one off this morning and got a phone call back. So that was a different thing. And this, of course, has to do with what I do in my business. I know people, so they call me back right away. But if you're trying to figure out who to go with, who's your best loan officer, what's the best option for this particular situation, look, you can always go to the Malibu Funding. It's www.malibufunding.net website. There's, 35, 40 different loan officers there. And my name is Jeff Barton. And of course, you can always call me. I would be happy to either direct you or try to answer your questions. You don't have to go with us as a loan company. Your needs really are important to us. It's what we do. It's what the radio show does each and every week. And if you're listening, thank you very much. If you're a first-time listener, this is what we do. We'll bring some guests on the show. We'll talk about problems. We'll talk about some issues. We'll bring competitors on. We'll bring lenders on. We'll talk about programs, problem solving, personalities. You may hear your next loan officer on the show. I'm Jeff Barton. I'm your voice for the mortgage industry. We're on 5 radio stations in 3 different states. We're on the Big 8 podcast, the big number 8 podcast, as well as on YouTube. We shoot this for video too, Jeff Barton, the mortgage voice. Thanks very much for tuning in, and we'll be right back.
Back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for getting us on air today, talking about loans and mortgages and trying to bring to you information that you're going to use, whether you're going to refinance, whether you're looking to purchase, whether you're just needing information about what's out there in the marketplace. We try to bring that to you each and every week. We are on the Big 8 podcast, so if you go there, great. You can hear this show and many archive shows. We're also on YouTube. If you go to YouTube, Jeff Barton, the Mortgage Voice, that's my YouTube channel. And if you like anything in there, say so. It helps us get to more people that have the information. It's just better because then they're forewarned and forearmed, as I like to say. We bring to the show each and every week some different guests and people who have way more knowledge about what's going on out there than I do. This week is no exception. Kate Zanabini is with us from Lending Home. First time on the show. Kate, how are you?
I'm great, and thanks so much for having me here today.
Thank you very much. I hope I didn't mispronounce your last name. I just, anyway, thanks for coming on the show.
It was perfect, so thank you.
Great.
You did quite well.
Excellent. All right, very good. Kate, you work for a company called Lending Home and doing a little bit of research on them. It seems to be a hot commodity right now. What makes Lending Home a good choice when you're looking for either a refinance or a purchase loan?
Yeah, absolutely. I would say what our bread and butter in the industry is going to be actually our fix and flip product. We offer 12 months, 18 months, and 24 months financing for investment real estate projects. So really, we're your go-to lender for residential investments. So whether that be a single family, 2 to 4 unit, you want to purchase it, renovate it, quick turnaround, we close quickly, and we offer that capital to, let people be able to close on more deals with, lower fees and a quicker turnaround time.
Hey, do you roll that mortgage to a 30-year, or are you strictly a short-term financier?
Yeah, and that's actually a really great question. So we started as, your just general bridge, fix and flip, short-term refinance, 12-month loan lender. But actually, we've just opened up our program here, and I think it's going to actually release by early November, which is in a few days, to do rental financing. So we are opening up to rental 30-year type programs.
Right.
It will be your typical, interest and principal, whereas our bridge loans will be strictly, interest-only loans.
Right. Okay. Interesting. Very interesting business, and interesting in terms of both availability of funds, which for a long time in COVID, we didn't have these kind of loans available. When did you start really hitting it hard, or have you been available the whole time?
Yeah, and yet again, so one of the things I think that helps us stand out as a company is our liquidity. So during the pandemic and everything that's going on, we never stopped lending. So a lot of these smaller types of companies, unfortunately, were institutionally backed, and they had to pause their programs. While us here at Lending Home, we have strong liquid, over $400 million in our own funds here. So we never stopped lending. We actually were profitable in August as a company, during this crazy time. And then I would say I think we hit our biggest loan volume, funded volume in August as well.
Wow.
During the pandemic. So I would say, during everything, when everyone shut down, we said, hey, come to us because we're still going to continue to close your loans.
Oh, that's excellent. You know, as you just said, we used to have a lot of non-QM lenders come on the show and talk about their products, and for a while there were plentiful, and then all of a sudden there were none. To hear that you were in the business and actually did some great lending in back in July and August, that's very encouraging. How long has your company been around?
So we've been around, I would say, since about 2013, actively lending.
Right.
And we've really, revamped the program and added more products and everything. I would say the last year or two, kind of expanding what we're doing. With that, what I help work on is the broker department. So I work with primarily mortgage brokers in the industry who are looking for quick financing for their borrowers. And that is something that we've really put a lot of attention into is how can we be competitive with brokers and make brokers want to utilize our systems here at Lending Home for their clients. And I'm not, you haven't asked me quite yet, but part of that, and that's going to be, working directly with borrowers and working with brokers. We have a state-of-the-art operation system.
Mm-hmm.
So here at, lendinghome.com, not only are we a mortgage company first, but we're a tech company second. We started in Silicon Valley. When I started way back when, it was like about 100 people. Now we're about 250 plus. So, we do focus not only on mortgage, but technology as well.
Interesting. Okay. The criteria you use to, I guess, fund your loans, the qualification process, the underwriting process, and then you're saying it's basically a tech-driven approach, your analysis, or is it file by file the old way where you have an underwriter looking at it, or is it a combination? How are you doing it?
Yeah, it's a little bit of both, I would say. So we do have, a group of processors, underwriters. We have our own team of appraisers, feasibility analysts in-house that, really evaluate not only, the files, borrowers, that we look at, scope of work and everything, but we also have our technology that allows you to go into lendinghome.com, put in information, and then basically generate a term sheet and a quick quote on whether or not we can do the deal. So, you don't have to wait around for, your account manager to check their emails in the morning. They can, borrowers and brokers can just go to lendinghome.com, put in a property, and they're able to generate, terms within seconds and minutes.
Are
the
these
actual system of Lending Home? We do have technology that you upload your documents, but we do have, people behind the technology, verifying everything.
I see. Okay. The criteria to get qualified for a loan is based on what? The property itself, credit score, ability to repay? What are you looking at most?
Yeah, a little bit of everything. So first and foremost, we're asset-based lenders. So we do look at the asset.
Mm-hmm.
Like I stated before, we only are offering financing for residential. So single family, 2 to 4 units, condos.
Right.
Is kind of the wheelhouse that we're staying into. So first and foremost, we make sure it's residential. Then we want to make sure it's investment only. So we don't do anything owner occupied. No rural properties. It's really got to be in an area that's heavily populated. So we do look at all of those things to make sure that the asset is in an area and a property that we can finance. And then we do underwrite the borrower as well. So we are a low doc lender. We don't collect any bank statements, no income verification. We will look at, entity documents. And then we do make sure that the borrower has a 680 plus FICO on the broker side.
Okay.
And then we don't allow for any sort of, bankruptcies in the last 24 months, mortgage rates. We want to make sure that these people, have a pretty solid credit history and background when it comes to our financing.
Hey, Kate, could you tell people how they can get in touch with you? Sounds a very good deal for a lot of people who still are in the flip business, certainly people who want to fix and sell commercial, of course. You could let people know how they can get in touch with you.
Yeah, absolutely. So first, you can go to lendinghome.com. If you're a direct borrower, you would have to go to Lending Home, and we would get you set up with, a direct salesperson to walk you through our systems and start submitting deals. For myself, I strictly work with brokers. So if you're a broker who's looking for, another source for your clientele, you can definitely reach out to me personally. And if you don't mind, I could give you my phone number and my email over the podcast. I'm not sure how you guys handle that.
Yeah, well, however you want. I mean, if you don't want to, that's fine. If you do, that's fine too.
Yeah, so you can, so my name is going to be Kate Zandobini. There's not many of us, so feel free to message me on LinkedIn. Also, you can call me. My number is going to be 415-688-4354. And then my email is very simple. It's just going to be Kate, Kate, dot my last name, which is spelled ZANOBINI @lendinghome.com.
Kate, thanks very much for coming on the show. I really appreciate it. And we'll have you back again soon to get an update as to the programs that you guys are offering. Thank you very much.
All right. Thank you.
Thank you. That's Kate Zanabini from Lending Home. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening, tuning in each and every week. We bring you information. We bring you programs. We bring you great guests. One of the guys that has been on the show many times, but not in the past 6 months or so, is Eric Morganson. He's from Angel Oak. I believe you're the regional VP over there, or maybe you've gotten a promotion. But Eric, how are you, first off?
I am doing great, Jeff. Doing great. Loving the mortgage business.
It's funny. We were talking off air, Eric and I, about what our business at Malibu Funding is and how we are faring and are we doing a lot of bank statement loans. And we were just talking about that aspect of it when I did the quick intro to bring Eric on. So Malibu, what are we doing? Yes, we're doing some of this non-QM bank statement type products. What are you offering at Angel Oak, which could be an attractive way to go with your company?
Well, what we specialize, Jeff, as you know, is the stuff that just doesn't fit agency, doesn't fit the, perfect prime jumbo, just the delta between hard money lenders out there and the very strict guidelines of A paper. We love that delta in between. We love super jumbo loans where somebody might have had a bankruptcy or foreclosure within the last 7 years. You see, Chase, Wells Fargo, the money center banks, and a lot of the big mortgage shops, they make a jumbo borrower wait 7 years if they've ever had a bankruptcy. Well, jumbo borrowers are normally always self-employed, and they're risk takers. And the risk takers, sometimes they don't have one, but they've had 2 or 3 bankruptcies in their past, and nobody's willing to touch them with a 10-foot pole. Up comes Angel Oak. We'll even do super jumbo loans, $2 million plus at 90% loan to value, and we never ever have any mortgage insurance.
Wow. How can you afford to do that? That sounds like a risk to me. Speaking of risk.
Well, it's not a risk when somebody is buying a $2 million property and is willing to put $200,000 down on that property. That's a lot of skin in the game, and they literally full doc. They prove that they can make those payments. If it's a bank statement loan, we go off of what they deposit either in their business or their personal checking account as an indication of their income. Not what they're telling the IRS with our 70,000-page tax code. You see, the tax code, as you know, Jeff, is designed to perpetuate the federal government, obviously. But our tax code is also designed for job creation. Those that are out there creating jobs get all sorts of tax benefits. those W-2 folks out there that don't create jobs do not. So the risk takers in our society, the self-employed that are creating jobs, when they create a job, that employee whose job they created due to taking risk they pay a payroll tax for them. That employee pays Social Security, Medicare, state and federal income tax on their wages. So you have senators like Elizabeth Warren. She's kind of up in arms that Amazon didn't really pay much in taxes a few years ago. Well, that was a year that they employed over 300,000 people. They, of course, got tax benefits for doing that. But look at the enormity of the tax revenue that came in from 300,000 jobs being created.
Well, you're preaching to the choir here. In my opinion, I think that what entrepreneurs, what people do to try to, as you said, create jobs or into the employment sphere in any realm, trying to risk their own money out of their own pocket to go out there and make something happen. I always think those people deserve a break anyway, even if they're gazillionaires like Jeff Bezos is. I mean, to me, he earned it. I remember when Amazon was a neophyte and nobody would give him any money. And it was really hard for them for the first 10 years before they really started to make any money. So, in that respect, you have to look at it in a hindsight situation and say, look, they did it, they earned it. And, look at 300,000 people, that's a lot of people to employ.
Well, and it's a lot, and there's a lot of risk. Most businesses really do not make it past the first 24 months and survive. So they're risk takers. They're hard workers. They're working Friday and Saturday nights, while candidly, a lot of W-2 wage earners are out partying Friday and Saturday nights. That's
right.
I don't think we have an income equality in this country. I think we have an effort inequality in this country. But getting back to these loan programs, a lot of folks are really not aware that they even exist. I'm surprised how many realtors don't understand the bank statement loan programs. And their idea is just collecting 12 months of your business or personal bank statements. You get a slightly better rate if it's 24 months, because a 2-year look at somebody's income is less risk than only a 1-year look back on somebody's income. But literally, as you know, Malibu does all the work. They just simply submit the bank statements, and we calculate the average monthly income based on their bank statements. That's the income you put on the loan application and simply fund the loan just like a normal loan.
Now, do you also look at Fico scores as much, or is this basically, equity kind of driven? And how much equity do you normally have? I mean, you said super jumbo at 90%, 200,000 into the deal, but that's not true with a $300,000 loan, is it?
Well, it is. We'll do $2 million on a bank statement loan at 90% loan to value. You do need to have a 720 FICO or better.
I see.
On bank statement loans, the credit scores start at 660, and it's all risk-based pricing. So obviously, the lower the loan to value, Jeff, the higher and the lower the FICO score, or the higher the FICO score is going to obviously get you a better rate with a lower loan to value. The higher the loan to value and the lower the FICO score, it's going to be a slightly higher rate. It's all risk-based pricing.
Now, how is the business? Everybody in the business is very busy. I assume you are as well.
We are very busy. The more people that are out there looking to refinance, they simply are coming across a roadblock. They either don't have the credit score for Fannie or Freddie or an agency loan. They're self-employed. When it comes to looking at their tax returns, they have too many write-offs, and they don't show enough income to qualify even for the loan they have, much less they're trying to lower their rates. So, in the state of California here, as you know, there's no inventory. So it is literally supply and demand kicking in. And boy, real estate everybody thought, oh, we're going to finally see a correction. Boy, was that ever wrong? Real estate prices have gone up. Now, if you, anything from $1.5 million down, that you're going to get 17 offers. Anything at around $2 million up, that inventory is doesn't move as fast, to say the least.
Yeah, it's really a difficult situation that we all thought would get, I guess, better because the forbearances would eventually have to go into foreclosures, but that may not happen. If we get a certain group in Washington, we're probably going to get another year extension on this forbearance, right?
Boy, I'm telling you, that is a whole other topic on
Right,
on
right.
two different philosophies when it comes to housing and the economy about to hit. And can we, it's anybody's game, no matter what happens.
Yeah,
However, we on these programs, we're okay with forbearance if the borrower, rightly so, didn't make their payments for 3 months. As long as the last 90 days they've been making their payments, then we're
right.
happy to do the loan for them. If they're in forbearance currently and want to refinance or go buy an investment property, we'd want to make sure that they just would make the next 3 payments, the next 3 months payments on their mortgages before we will engage in another loan with them.
Right, that's pretty standard in terms of what the solutions are for those people who come out of forbearance. Listen, we're up against it. Could you shout out your phone number for anybody who needs a terrific type of bank statement loan and other loan services from Angel Oak? That'd be great if you give us your number.
Sure. My number is 949-554-5000. That's 949-554-5000. My name is Eric Morganson, and Jeff, always a pleasure.
Thanks very much, Eric. You've always a pleasure to come on. It brings such energy and excitement, and obviously a strong opinion on things. Always good for radio, and I really appreciate it. Thanks for coming on.
Cheers now. Bye-bye.
Thank you. All right, bye-bye. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Everybody, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening each and every week. We try to bring you the most updated information, but occasionally we get into some long-term issues that affect the mortgage market, affect the real estate market. Certainly we've been in one since COVID, and the rates have really been as low as they've ever been. It's really astounding to me that we've been able to really remain at these incredibly low rates. But as you can imagine, most people want the even lower rates. So we try to look to the bond market a little bit, see if the Fed is going to purchase more mortgage-backed securities or treasuries, and all of these things affect mortgage markets and affect mortgage rates, qualifications for those rates. It's all dependent upon really the quality of the person you're going to deal with, person you're going to talk to at the big box bank or at the mortgage lender or at the mortgage broker. And so we always bring to you guests that have that experience and give us their benefit of experience through some of the interviews that we do. Michelle Dryden from Olson Agency is no exception. She joins us now. First time on the show. Michelle, thanks very much for doing this. Thanks for coming on, and how are you doing?
Thanks, Jeff. Thanks for having me. I'm doing great today. Just keeping busy. It's a lot going on out there.
There is a lot going on. I had a guest previously. I was talking about some of the exhaustion in the mortgage industry as a rule in general, because we've been really at a sprint pace after being at a very fast jog for the last 10 years. How are you doing? How is the volume affecting the quality? And what are you telling your people about the quickness by which you can get the loan done?
Well, basically, I love to give my clients, all the information up front and give them the laundry list of things that they need to do in order to purchase a home or refinance, whatever it may be that they're looking to do. I don't believe in putting sunshine where it doesn't belong. So a lot of people out there will, say they can do something and they really can't. And I think it's really important that your client always has all the information so they can make the best decision for themselves.
I agree.
The market out there right now, rates are great, as you know. And
yep.
the market for purchasing is very competitive. It's very much a seller's market as well, so it makes it difficult on a lot of buyers. So you really have to have your loan ready to go. And for me, basically, I mean, I can close really quickly. It just depends on how quickly every other party can react as well. But you know, I've closed the loan in 17 days. So
Right.
it's a purchase loan. So it can happen. It just everyone has to be organized. You have to have your loan has to be taken care of first before you even start looking for properties. So important in this market, especially.
Tell us what you do on your initial interview with a client. How do you do your interviews? Obviously, now it has to be by either video or by phone. What are you telling your clients what they need in order to get that jump on the competition walking into a real estate offer?
Yeah, basically, most of my clients I meet on the phone, and we discuss things via email as well, sometimes text, whatever is comfortable with them. But I give them the full out everything that they would absolutely need. I try to look at things from an underwriter's perspective when they're purchasing a home, and even if they're refinancing, I want it to be the cleanest approval that they won't have to be coming in with hardly anything in terms of conditions once they get their
Right.
initial approval. So anything from tax returns to, last 30 days of pay stubs, all their assets accounts for the last 2 months, all pages, their identification, their
Right.
profit and loss statements, everything that you can imagine that they would need from an underwriter's perspective, I try and get up front with them so they know that, this is going to go through.
Describe your typical borrower, if there is such a thing right now. Are they someone with a 700 Fico score and W-2? Are they self-employed? Are they FHA borrowers? Describe the type of customers that you're doing right now.
A lot of my customers, it's a combination of W-2 and self-employed.
Right.
I have a lot of anywhere from, they're A borrowers mainly from what I'm saying, and obviously, with COVID, there are a lot of COVID overlays in the underwriting process, so I have to really know exactly what's going on with them when it comes to their income and their employment. So a little mixture of, someone buying their first home versus a lot of refinances still at this point too. So.
Now, the ability to repay, you mentioned that in terms of what underwriters and the lenders are looking at. They're obviously checking with the verification of employment. Explain to me how you're explaining it to your clients that this is probably the most important thing, especially during COVID.
Yeah, absolutely. It is very important because, right before, final loan docs are going to be drawn, we have to verify employment again. And I let my clients know up front, please give me, whoever it is that is going to be verifying the employment and their
Right.
human resources or whoever it happens to be. And I need to get their name and phone number so I can make sure that is done. And it's done in a timely process, and I let them know how important it is so they can
Yep.
pass it on to their human resource person, whoever it is that's verifying the employment. So they know that they're not just getting these calls over and over again and that someone's not paying attention. It's just because this is an overlay and it's very important to verify.
The company you work for, Olson, how long have you been over there? And you sound so experienced. You must be the owner of that company. And I say that because I talk to many, many people in the industry, and having not only the experience, but the knowledge and then the confidence with which to be able to talk to professionals is so much a part of what we do. It just seems like a natural for you. Tell us about Olson. What's going on over there?
Well, actually, I work, I'm a mortgage broker and I'm a real estate broker. So I do both.
I see.
And basically, my real estate broker is held with the Olson Agency. And then my mortgage brokerage is held with Omega Lending. And
I see. Okay.
so basically,
Perfect.
I I do both for both companies. I don't do them both together because that's, in my personal opinion, is not ethical. So I
Mine
keep them
too.
separate. But I've been in this business for almost 23 years now. So I've been around the block, and I did own my own company for 13 years, and then I had lots of kids. So
oh, good for you.
decided to kind of lay low for a little bit, and then came roaring back in. So here I am.
No, I'm glad you gave us a little bit of your personal too. I think in our business, there's so much technical that sometimes we lose the fact that, talking from the heart to the client or people we're talking to, getting to know them a little bit really helps in the relationship aspect of what we do. I too have children, and they're all grown.
Absolutely. Relationship is key, and I have to say, I mean, I've had a lot of my clients have been clients of mine for years and years and years. So, and then basically, it's word of mouth as a referral for me. So that's how I've worked my business pretty much, the last 23 years.
Hey, could you shout out your phone number for people and who want to get a hold of a terrific loan officer, real estate agent?
Thank you. I appreciate that. Yes,
Sure.
Again, my name is Michelle Dryden, and you can reach me at 818-437-7876, and I would love to help you, whether it's with mortgage or real estate. I'm here to help and make sure that you get what you're looking for.
Michelle, thanks for coming on the show. I really appreciate it. You knocked it out of the park, as I knew you would, and we'll have you back soon. Thanks very much.
Thank you, Jeff. Have a great day.
And you too. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hey, welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening, for tuning in. We are on the Big 8 podcast. And Daryl, I think you have a list of them somewhere. Yes?
I do. It's right handy here. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMediaRadio.com, and YouTube.
Excellent. Thank you. That's the Big 8. We're on all of those podcasts, and we are archived there too. So if you've missed a show, you want to see some of the guests we've had in the past month or two, or go back prior to COVID and see what we were saying. It's interesting because we have such change in what we do as a business all the time. To see where we thought it was going at one point and then to see where we are today only really tells us that the future is completely unknown. I don't know. Daryl, do you know who Larry Kudlow is?
No.
Okay. Larry Kudlow used to be on, I think he was on Fox. He could have been on CNBC. He was a business guy, and he came from Wall Street, went into television, and then the president asked him to come on as the Council of Economic Advisors, and he's advising the president. And when COVID first hit, there was a huge stimulus in order to get people to, continue at least to pay their bills while we tried to figure out what was happening with COVID. So towards the end of the first, or right before we ended the $600 a month, maybe this was in July, end of June, early part of July, there was talk that people didn't want to go back to work. This is when this huge push, let's go back to work. Come on, everybody back to work. There was this huge push to put people back to work. And one of the people shouting the loudest from Washington was this guy, Larry Kudlow, who said, look, we are disincentivizing people by paying them more on unemployment than they would get if they actually went back to work. And this was, of course, the short-sightedness, not knowing that the pandemic would reappear. And as we all know now, it is worse than it's ever been. So that kind of analysis or push at that time by some very smart people. Larry Kudlow is a very smart person, but it looks rather silly, right? I mean, you're now telling people, oh, okay, so we're going to try to get a coronavirus package through now, when in fact you could have just extended what they had, which they didn't do. And the people that are hurting, and as I mentioned, the groups and the people who are currently still unemployed, as well as kids, and I say kids, anybody under 25 who got out of college in the last couple, 3 years, who has had struggles trying to get a job. My children are the same. They're in that age group, and they've been struggling. So I know about what that is, and what the struggle is. But for people trying to put food on the table, and all the things that we say are terrible when people lose work, Larry Kudlow looks like just complete idiot, because you cannot predict the future. We don't know what's going to happen. So therefore, we all tread very carefully as to what we predict or not predict. Unless you're in the sports world, heck, they predict every day and it's all wrong and it's all good, right? I mean, it's all about, having a good time. But in this pandemic and what we're trying to do now, it is not about what's all good or what's having a good time. It's trying to give people some ability to be able to get through today, plan for tomorrow, and to be able to supply some kind of stimulus to them. In regards to that, some of the numbers that have come out recently in the last few days about the gross national product, it snapped back at raising at 7.9%. Well, I've been seeing these graphs, and when you look at the graphs, and I'm not a graph person, I'm not necessarily a linear person either. I don't see A to B, and because I see A to B, that means B to C is going to look pretty much like that. I just don't know. But the numbers for the past 7 presidents and where they were in their first, term, in terms of where the country was economically, it was kind of interesting, although very few of the presidents in those 7 had to deal with a pandemic like this particular president. But anyway, in the third quarter this year, 7.6% the economy grew, and it grew, so it's now almost in positive territory, but nowhere near where we were back in March. And it's probably the number one reason why we're going to have a change, right, in leadership in Washington. And I don't say I prefer that. I just say it just kind of looks that way. And because most people, especially in rural areas, in the urban setting, in cities, who work those kind of jobs that require people getting in rooms together, whether it's at the sports stadium or the local restaurant, they're just not coming back right now. And they may not come back, from what I understand, until the following year, meaning 2022, not 2021. There may be a recovery, but not for those type of businesses. And that's not easy to deal with, and trying to help those people so that they can pay down their mortgages, or they can resume paying bills that they've forgotten about, or to be able to just, pay the rent. All of this has to happen. It probably will, and I hope it will sooner than later, even if it's one administration or another. As I say, I don't really care. I just know that the country needs it, those people need it, and in order to get us to that point, we have to make some commitments that we may or may not be able to do until there's a new Congress. But again, this is not a political show. This is just trying to see what it is out there. However, it has not stalled or slowed down the real estate market. We see real estate prices really this year rise from 5 to 8% nationally. There are pockets in certain areas, whether it's a certain area down in Albuquerque or up in Las Vegas, certainly in the areas up in Tahoe where they've had the fires, they've been impacted by a completely different thing. I know Malibu Funding, the company that I work for and sponsors the show, they have offices in a number of different states, and down in the southeast, heck, they just got beaten again by another tropical storm. So we know lending down there is also tough. And it's also affected property values and the ability by which any lender is going to go out there and lend, whether it's in the fire zone or whether it's in the flood zone, or whether it's due to a fact that you've lost a job and you can't get one back. There's just no way that you can either refinance or get a new purchase loan unless you can prove that you've had a job, you're going to continue to have a job, and they do a verification of employment, and they do it 3 times during the loan, and they make that almost as important as anything else within the loan. Nobody wants to get stuck with a loan that's in forbearance. Nobody wants to get stuck with a loan that you can't pay after 2 months of getting that loan. So the rigorous, I guess, scrutiny of who you are and what your job is really important. I've had a couple of loans myself this year fall through simply because of that nature. We've had some issues with slow turn times. That is an issue across the board, even though we've seen some hiring at the major banks. For instance, we've got Wells Fargo as well as Citibank saying that their turn times or the speed of their particular loan delivery is up 7% to, it's at 25%. Can that be right? Could be, respectively, meaning that they've obviously hired and their processes are good enough to whereby they can, get a loan done that much more quickly. Whereas some of the other lenders who are competing for underwriters and funders and closers and doc drawers and all these things, which are required in any lending institution, they're at a premium because there are many small lenders. Let's say there's 9,000 lenders in the United States. Of that, maybe half of those are credit unions and banks. The rest of them are mortgage companies. Well, the mortgage companies who are lenders, mortgage bankers, let's say, they're all competing for those particular job skills. And as a result, there's a shortage. But as we all know, it's going to change. Like everything else, and like what I said at the beginning of the particular segment, things change in our business quickly. And what we see today as a lack of some job skills out there in the marketplace, tomorrow may be many, because the market may turn. We may see a different kind of market next year. I think we're going to see a lot of the same market, although there are predictions, and of course, here we go with predictions. There are predictions that the mortgage refinances will be halved, meaning we're not going to see 66% of all mortgages be refied, more like 40%. And that would be 33 to 40%. That would be half. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. You can go to YouTube if you want to see this show, Jeff Barton, the Mortgage Voice. Love to have you. And by the way, say that you like it. Join up. Let us know that you want to hear more information just like this. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.